Okay, let's go over selling assets. In this case, we're going to sell some equipment. Let's be specific here. Let's call this equipment. Okay, so we decided that this equipment, we were going to purchase it for $70,000. And we're doing this on January the 1st of 2014. The decision is made that we're going to depreciate it straight line, which that's good news for accounting students, and that its salvage value at the end of 10 years is $1,000. Remember that we take into account salvage value in all the depreciation methods. The only kind of twist is that on the double declining balance, the only time we really factor in salvage value is the very last year that we take depreciation. But all the others, including straight line, you have to factor in salvage value. So we have all our markers. We have the cost, we have the number of years, we have the fact that it's straight line, and then we've been given a salvage value. We also could have been given a salvage value of 0. That's not impossible either. Some things really aren't worth anything at the end, and they're just donated or something like that. So what would the entry be on January the 14th when we purchase this $70,000 asset? Let me give you a minute to think about it and work through it. Okay, so I'm back. Let's look at the entry. Obviously, people do not donate equipment to us here. We have to pay for it, so we set up the asset at $70,000, and then we obviously are out the cash of $70,000. Notice the salvage value is not really a player here. The salvage value is going to come into play when we start depreciating. So, speaking of depreciation, what entry should we make on 12/31/14? So we're going to go ahead and accrue depreciation and not lie to the outside world and tell people, hey, this equipment that we bought for $70,000 is actually worth less now. So let's think about this entry. What would you book after 1 year from 1/1 to 12/31? I'll give you a minute. Okay, let's look at that entry. What we would do is we would take the cost, the historical cost of $70,000, which is up here. We would subtract salvage value. We don't depreciate salvage value. We depreciate to salvage value, and that's true of all the depreciation methods. And it's basically $70,000 minus $1,000 of salvage value over 10 years. And this represents 1 full year of depreciation, which happens to be what we're depreciating here from 1/1 to 12/31. So let's throw a twist in this. Let's say on 7/1, halfway through the next year, keep your calendaring straight. It will really help you on test day. So we went from 1/1 to 12/31, and now we've gone 7 months into the next year. You'll notice that 7/1 is exactly halfway through the year. What entry should you make on 7/1? I'll give you a minute to contemplate this. Okay, let's look and see what entries we'd make. First of all, you will note, please, when something is sold for $63,000, please get the cash entry right. At least we've got that to anchor us, right? And then something really important happens. We need to take off the books the accumulated depreciation. Now, the problem we have is accumulated depreciation needs to be updated to the latest. So this is what accumulated depreciation is after 1 year. Remember, we took 1 year's worth, but we sold this on 7/1. So the first thing we want to do is we want to come in here and we want to update depreciation. We want to bring accumulated depreciation up to the sale date of 7/1/15. Relatively easy. You'll notice that in the same way that we make an entry at year end for 70,000 minus the $1,000 salvage divided by 10 years. Remember, that's why I made an emphasis to say this represents 1 full year. But we're not going 1 full year. We're going halfway through the year, right? So if we're going halfway through the year, it's very easy. It's 70,000 minus the $1,000 of salvage value divided by 10 years. And take half of that. I've kind of made it very verbose here, but basically you multiply by 6 months. That's the number of months that exists from the beginning of the year to 7/1. divided by 12 years. If it's easier for you to just know, oh, I take a half year and multiply by 0.5, that's fine. I just kind of described it here a little bit more verbose so you can see what's happening from 1-1 from 1-1 to, or 12/31, whichever your preference is, to 7-1 is exactly 6 months. So it's 6 months divided by 12 months times what you would normally take for a full year, and it's 3450. So this is step one. Okay, we do that first when we have a sale. We have to do that because unless we're just given the book value on the day of the sale, we don't know what book value is. And remember that net book value is the historical cost minus the latest version of accumulated depreciation, the latest cumulative amount that's been put into this account, accumulated depreciation. Well, we've only put this much in, 1 year's worth. The problem is we're selling 6 months into the next year. So we have to fill that up for another 6 months, and then we truly have net book value. So that lets us make our entry. We've got cash, which is an automatic entry. We know what this is. This is historical cost. And now we know what accumulated depreciation should be. Accumulated depreciation should not be 6,900. That's what it was 6 months ago. It needs to be updated to the sale date of 7/1, and it turns out to be 10,350. Whoa, that's not good. There. And this leaves us with a gain, the plug, the adjusting entry, whatever you're going to call it. This is the gain that we experienced on that sale. Pay close attention because if you notice here, the net book value of this is the 70,000 minus the 10,350. Be mindful because net book value sometimes has to be calculated and sometimes it's just given to you. So if you look here, the net book value of this is 59,650. If, for example, you know that 59,650 is the net book value, then to get the gain or the loss, you just take the amount of cash, however much it's sold for, and subtract the net book value. In this particular problem I'm working, we know what the historical cost is, and we've caught up accumulated depreciation to the date of the sale. But you can also be told book value is this. And in that case, what book value means is, hey, you don't have to worry about knowing this and this. This minus this has been given to you. So let's change it around a little bit. Let's say that same sale date of 7/1/15. Now let's sell it for $5,000, which you'll notice is quite significantly a lot less than $63,000. So we should expect to not see a gain on sale. We should expect to see a loss. So I'll let you work through that for a second. Okay, let's look at what that entry would look like. You notice it's identical. We got cash of 5,000. And you'll notice that the accumulated depreciation is the same. Let me adjust this for a second. Accumulated depreciation is the same. Again, just like before, you have to get it caught up to the most recent, to the sale date, which continues to be 6,900 plus 3,450, 1 year's worth and a half year's worth. And you have to take the equipment off the books, just like you normally did before. If you'll notice here, we did the exact same thing here before, took it off the books with a credit. And then, of course, the difference between the cash we took in and the book value, the net book value, which in this case, again, remains 70,000 minus 10,350, is the 54,650. So here we have actually a loss on the sale of the equipment. It's been an example of buying equipment, depreciating it. You notice we took a full year's worth here to reflect 12 months. And then when we learned that we were going to sell it on 7/1, we got depreciation caught up for that 6 month, additional 6 months. And then basically then we just have an example of a gain on sale where we take the cash, we debit the cash that's coming towards us, and then we take the equipment off the books at historical cost, and then the latest version of accumulated depreciation. The net of these two is net book value, so that minus net book value is the gain. In the same way here, what we collected minus the net book value is the loss. So I hope you found this useful as you study for the final.